Hey, it's Giuseppe here with Zenith Home Loans. Thank you so much for reaching out. Purpose of this video is just to explain what's going on in the markets because no one's actually talking about what is actually going on with mortgage interest rates. And the second reason is to set proper expectations to move forward in this new world of mortgages that we see ourselves in for the foreseeable future. So first thing, 2 weeks ago, we had a significant interest rate drop. Almost a full 1% over a 1 week period that caused a frenzy across the country of people applying for these low rates. The mortgage industry was presented with about $5 trillion worth of volume of potential refinances within a week. And our industry is really set up to close about $2 trillion, maybe $2.5 trillion of refinances over a 12-month period. So that huge influx almost broke the financial markets. During the same time, the stock market was already in decline, and which during normal times would be actually really good news for interest rates. All that money would be coming out of the stock market, flow into the bond market, and keep mortgage rates really low. That did not happen last week because the concerns over the coronavirus. It wasn't just people switching their investments from stocks to bonds. People needed and companies needed liquidity, so they cashed everything in, bonds and stocks. Banks who were trying to slow the influx of applications decided to raise interest rates to slow down the volume that was coming in the door, and that led to mortgage rates spiking over 1% over a 4-day period. Now, Sunday, the Federal Reserve had an emergency meeting to reduce the Fed funds rate by 1% to 0%. A couple things you need to know. The Federal Reserve does not control mortgage rates. They only control the Fed funds rate, which is the rate that banks charge each other to borrow money overnight. The prime rate is 3 plus the Fed funds rate. So anything that is tied to the prime rate, like a car loan, credit card, home equity lines, will see a 1% rate drop from last week. The Fed will also begin some quantitative easing. We saw this back in 2008 during the financial crisis. This includes purchasing a commitment so far of $700 billion of treasury bonds and mortgage bonds to stimulate the economy and keep rates low. This does not mean that mortgage rates will plummet again and end up at 2% or some number we've never seen. What they will do, what it does mean essentially, is that interest rates will systematically go down over the next weeks and months. And this is going to present great opportunities for people to save money on a refinance, but in a more controlled manner so it doesn't break the financial systems. Thank you for listening to this video about what's going on. Please be patient. Things are going to take a little bit longer, whether it's with us or any lender you're working with. If you're buying a home, you do have to lock in a rate before you can close. So let's discuss together, make a good decision. Definitely my advice would be to not pay any points, to try and get the lowest rate, because chances are good that we will see lower rates down the road. And in the long term, you're probably going to not keep the loan you're getting right now for very long. So keep the fees low, keep the rate maybe a little bit higher, but save yourself all the fees. If you're considering a refinance, there's no rush to lock in right now. Let's make sure the break-even period that you're considering is very short so that you can take advantage of lower rates down the road if they present themselves. It can take weeks, maybe a month before the market gets back to normal and decides where it wants to be. So the smart thing to do is get everything set up so that we're ready to go, and when rates drop, we can get it protected for you, okay? Thanks again, and call me with any questions. We'll talk to you soon. Bye-bye.